How are you, Clive?
Hello, Darcy. Doing well. I'm in Switzerland. It's 10 o'clock at night. I think you're early morning the next day.
Exactly, 10 o'clock in the morning. You have been retired for almost 50 years now in the wealth management private banking space based in Switzerland. So I wanted to start off this discussion by asking you, because I've heard a lot about what you've talked about online now for probably almost a couple of years now. And some of the stuff that we're going to be talking about today is not necessarily covered with a lot of the mainstream people that I hear daily. Were you as kind of open with your clients when you were in wealth management as you are today now that you're retired?
I think that's what helped me keep my clients. Most of my clients were with me for 25, 30 plus years, some longer than that. And I think they stuck around with me because I told it the way I saw it and not the way the bank told us to tell the clients. All banks have got something to sell. I'd often say to a client, well, we've got this new product, but frankly, I'm not going to buy it myself. And the client would say, well, if you're not having it, I'm not having it. What are you buying, Clive? I say, well, I shouldn't be saying this, but I've got this little stock or this interesting situation.
Yeah, yeah.
Okay, I'll have some of that. Well, I didn't advise you, did I? No, 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 my idea.
That's one way. That's one way to get around it. But obviously, you're the powers above. We're pretty pleased with what you did if you were there for that long. Um,
Oh, yes, the clients were very pleased and they made money. That was the main thing.
that's the main thing. Yeah, ultimately, yeah, that's what we're here for. And so, kind of what I do as a financial advisor is almost like what you would have done, except you've got about 25 years more experience at least, and a significantly larger brain than me. So let's start picking away that brain. And I want to start here in New Zealand because it's where I am. Central banks. So the Reserve Bank of New Zealand, the governor Adrian Orr recently stated that central banking is a great business to be in because you can print money and you can get away with it as long as people believe it. So I just wanted to throw that quote out there and ask you a question around central banking. Do you feel like there is a declining sense of trust in terms of, say, not only government, but central banks?
The distrust is growing. In fact, I think it's getting shouted from the rooftops now. When I started out talking about central banks, which would have been maybe 30 years ago, and I was at that time I was talking about the generalized increase in the money supply, which was devaluing what you could buy with it. So that was the reason why house prices were going up, the gold price was going up, stocks were going up. It wasn't that they were all worth that much more. It was just basically the money bought you that much less because there was so much more of it.
Mm-hmm.
It's a bit like when the conquistadors arrived in South America and they started to exchange glass beads for gold with the local population. Well, after a while, the area was so flooded with glass beads that nobody wanted it anymore. It wasn't worth as much as it was when they arrived. Every government which has ever existed has always been tempted to overspend, and they do that either by debasing the money supply. That means in the old days adding some base metals to the gold coins, or by borrowing. And eventually the situation comes when the money becomes worthless or they can't repay their loans and the system restarts and we have a new system. And once again, a new currency comes into existence and they debase that. The world we're living in today is a little bit more sophisticated because we've gone completely off the gold standard, and that's taken away any discipline whatsoever. And it means that governments have got two things that they could do. One, they could borrow themselves with no prospect of ever repaying because they know that eventually their central bank will print the money that's needed to repay those loans, or they could just simply have the central bank print money. And the question which everybody should be asking is, well, if you can print money with impunity, why are we paying taxes? Why not just
Exactly.
print the stuff?
Yeah.
Well, you know the answer to that because the distrust of the money would increase much faster. But printing some of the money, which is what's going on, it's just the same as printing all the money. It just goes slower. So we're in a situation where the amount of money being printed relative to what's being collected in taxes around the world is accelerating, and the distrust is growing.
And do you think those things are highly correlated, like the amount of tax that we pay and the amount of currency debasement that's happening? Is there a correlation between that, or is it really just all about that sense of trust? Like, I kind of wonder if it's also to take away power from some people and reallocate it. But is it really just all about trust?
The trust exists because of history. the move from the gold standard it was done very subtly, even though when we look back on it, it does seem quite sudden. But if I just walk you back to the USA, which really was the last country to be on the gold standard, in 1933, they were in the middle of the Great Depression. The United States was running out of money; they couldn't pay the bills, and because of the Great Depression, the banks were running out of money. They were going bust. I think there was about 5,000 banks went bust in the 1930s. So people started queuing up at the banks to withdraw their money, and money was gold. So the gold coin in the United States at the time was the double eagle, the $20 gold coin. They had the eagle, which was $10. And they were taking their money out in gold coins and putting it under their pillow or wherever they put it. Now, the problem with that was it was basically a run on the banks. And the other problem with that was there was less and less gold in the system. And remember, there was a Great Depression. The way you get out of a Great Depression or any depression or recession is to print some money or at least increase the money supply. But the money was draining out of the system and it wasn't there to grease the wheels of the economy. So Roosevelt took over from Hoover. And literally within his first day of being president, he called a bank holiday to stop the run on the banks. That was a 4-day bank holiday. And during those 4 days, he promised the population that when the banks reopen, those which do reopen will be completely safe and you can put your money back in the bank. It'd be a lot safer in the bank than under your pillow. They did reopen the banks, not all of them, because many of them never reopened, but those which did reopen, there were quite a few people queuing up to put their money into the banks, trusting that everything was going to be safe now. That, with hindsight, probably wasn't the best idea for those who did it, but that's what they did. There still wasn't enough money going into the banks at that time to grease the wheels of the economy. So about a month later, he issued what's called the Executive Order 6102, a very, very famous document which recalled all the golds in the United States and ordered the population to hand in their gold to the Federal Reserve in return for paper bank notes or paper Federal Reserve notes. And the population duly lined up, handed their coins in and got paper notes. Of course, not everybody handed their coins in. Most people sincerely and honestly believed that once the crisis was over, they'd be able to change their paper notes back into gold. But that day for the American population never came. And if we step forward about a year, by 1934, January the 30th, 1934, was the date when he reduced the gold content of the dollar. The dollar contained a certain amount of gold, and he was authorized by the Gold Act to reduce that by up to 50%. And he did that. He reduced it by about 41%, which meant that the gold price was 61% more, or the gold content was 41% less. And the population now were holding these paper banknotes, which they still in their heads thought was kind of gold, believing the day would come when they could change it back. That day never came, and although foreign governments could technically change their dollars for gold right through till about 1971. In 1971, some foreign governments, the French notably, were going to the United States and asking for their dollars to be changed in gold because they had a surplus of dollars. And the American government said, look, we can't give you your gold because if we give it to you, it'd be unfair to everybody else because we won't have enough for everybody. So you can't have your gold, but you can have dollars for your dollars. And that was it. That was Nixon took the United States off the gold standard permanently. It still remained illegal for Americans to own gold right through to 1975. But people by then had got absolutely used to using dollars. And it wasn't just in the United States, it was all around the world, because the entire world, after the Bretton Woods Conference in 1944, went on to what's called a dollar standard. So every currency in the world was changeable into dollars at a fixed rate, more or less every country. And then those dollars, in theory, if you weren't in the United States, could be changed into gold, although in practice, it wasn't really changed into gold. So the world had pretty much got used to using paper money. They became accustomed to it. But what we saw after 1971, when America was completely off the gold standard, America started to realize that they could print with impunity.
Mm.
Now, it didn't happen too fast at first, but it gradually became more and more. And as they printed, other countries, to stay up, keep up with the American printing and thus devalue their currencies against the dollar, or at least keep their currencies falling at the same rate that the dollar was falling, they also printed. And it was a very convenient thing for every country around the world to be able to print their local currency because it meant they could spend more, satisfy the population more, and keep the government in question, which was in power, in power. Uh, Now, that carried on for many, many years. And then let's step forward to the 2008 banking crisis, which really changed everything. All around the world, governments decided to bail out their banks as they're too big to fail. So the banks had lost a ton of money on dodgy mortgages, a lot of them from the United States, but basically they lost a lot of money and they had to be kept alive because if the banks aren't alive, the government can't collect its taxes. So the governments bailed in all the banks. They put in billions and billions and billions of dollars. And to get those dollars or pounds or euros or whatever it was, they borrowed the money and and the central bank bought many of those bonds which the government was borrowing, with the net result that they flooded the system with money. And the consequence of that is we've had since 2008 something which has always been there, but we've had at an accelerated rate a boom in gold prices, in house prices, in stock markets, and anything else which has got a tangible value. And the more rare it is, and the more desired it is, that the faster the growth has been. So obviously things like a Van Gogh or a mansion by the sea is going up in value faster than perhaps, say, the stock market. Then if we step forward, we had the COVID crisis, which once again the governments around the world saw fit to give everybody some pay while they were not working to keep the jobs alive. They would either pay the firm or pay the individual some money, basically keep the economy alive. That was another round of massive printing. And there didn't seem to be, at the time, with either of these events, the 2008 printing or the 2021 printing, there didn't seem to be any negative effects at first. So now the governments had all these programs going of social welfare and all kinds of projects left, right, and center seemingly without any consequences. And the way they were funding these was by borrowing more and more. So the situation in the United States, and it's the same around the world, is governments are borrowing at a faster rate than ever before.
Mm.
That wasn't such a bad thing because interest rates around the world were down to zero. For example, for many, many years, the American prime rate was 0.25%. In Europe, the central bank rate was as little as minus 0.5%, and so on. So borrowing rates for the government, they were borrowing all these with their bonds. They would issue a bond for 10 or 20 years, and the rate of interest on that would be a very low percentage, 1 or 2 or 3%. But now we're in a situation where interest rates are starting to rise because governments are trying to rein in the inflation which was caused by all this printing.
Mm-hmm.
And the classical way, according to the economics books, is you raise interest rates and cause the economy to slow because people stop borrowing and people lose their jobs and that sort of thing. And then the inflation rate comes down because you no longer have as much what they call demand pull. So as people get poorer, they don't bid up the prices of goods and services. That's the classical economic theory. I don't really think that applies in the modern world. We're living in a different world from John Maynard Keynes was around.
Exactly.
But the trouble is, as we stand, it's very, very hard for any government to give up on their pet projects and their spending. They don't want to raise taxes very much if they can avoid it, because that's kind of like the turkeys voting for Christmas. Don't forget the politicians are the rich guys. They don't really want to cut social benefits because they'll have a civil unrest on their hands. So they're in a bit of a dilemma as to what to do. Can't raise taxes, can't cut spending, and the difference between the two is getting larger and larger. So that means the government debt's getting larger and larger, and at the same time, that extra money they're having to borrow is having to be borrowed at a much higher rate than any time in the last 20 years.
Mm-hmm.
So with these higher rates of borrowing, it means that the interest charge on the government debt is starting to rise very rapidly.
Hmm.
And if I can take the United States as an example, depending on a number of factors, such as the interest rate and how much their deficit is, but it looks to me like it's possible that within 10 years and possibly within 6 years, their interest charge could be exceeding the totality of their tax revenues.
It's insane. So it's almost like they've snookered themselves into a corner. It's you've just painted a picture really of, I don't know how many years that is, probably about 60 years of the decay or the death of the current financial system from Bretton Woods to today. And now they're kind of like they're in a corner, right? And so that's the thing that I'm trying to figure out right now is there more life left in the system, or is this the end? It doesn't feel like it's the end. It feels like there's at least a little bit more juice in the tank, right?
Future historians will look back on us and say we were 99% of the way there.
Right.
I can illustrate that a little bit. When I was probably 6 years old, I was paying a visit to my grandfather's house, and he had some friends around, and he put on the table an English pound note and a bar of Cadbury's chocolate, which was it's sixpence. So if you're from New Zealand, I don't know if you know this, but back then we had 240 pennies in a pound. That meant that with a pound note, I would have been able to buy 40 bars of chocolate, or or take the pound note, same thing. But of course, I was only about 6 years old, didn't know the difference. So when he offers me the choice of take the pound note or the bar of chocolate, I took the bar of chocolate. And I remember him and all his friends laughing out loud at my silly choice. And then he explained to me that the pound was worth £1 could have bought me 40 bars of chocolate. So I learned the kind of lesson then. And I went back again a year later. My grandfather tried to play the same trick in front of his friends again. But this time he put down the pound note, the bar of chocolate, and a £1 gold sovereign, which you couldn't spend in those days, and asked me which I'd take. Well, I'd wised up a bit, so I took the pound note. And he then laughed and said, well, you should have taken the sovereign. It's worth £3. Or he didn't actually say it's worth £3, but I now know it would have been worth about £3. His friends didn't understand it because they'd never seen a sovereign, and sovereigns weren't circulating, and they'd been out of circulation for 50 odd years. And he tried to explain Gresham's law, that the reason there's no gold circulating, the no £1 gold coins circulating, is because they're more valuable than the £1 banknote. If we step forward today, I don't think you could buy a bar of chocolate for £1, not the same bar of chocolate as you could buy then. So certainly most of the value of the pound has deteriorated. I think I did a calculation against gold recently since 1971, and it had lost 99% of its value against gold. And in the United States, it lost something like 97% of its value against gold. So the question you asked is, are we near the end, or have we got some juice left in the system? Yes, we have some juice left in the system, but we're much nearer the end than the beginning.
We've only got one square to spare on that chocolate bar. If you just described before the final stage death of the fiat financial system, what I found really insightful with what you were describing before is that when the US decided in 1971 to go off the gold standard completely, other countries around the world were kind of forced into printing their currency at the same rate. And I just wonder in the back of my mind how many times there were other reasons pointed at for why there had to be currency debasement happening in those countries, when in reality, it was just to keep on pace with the US. And then when you compare it to today, when there's so much synchronicity with central bank policy, looking at the Fed funds rate, and here in New Zealand, there's an OCR announcement, an official cash rate announcement just in a few hours. And I just wonder, the story will be what the story will be, but really it's about synchronicity, isn't it? It's about keeping up with the US still, right?
Oh, yeah, exactly. Over the last 50 years, since 1971, all currencies have been going down in tandem with the dollar. Now, the dollar has been going down less fast than the rest, but the realistic point is every currency on the planet is buying you a lot less than it did 50 years ago, because they've all resorted to printing, or And well, I say and because it's and the government has resorted to borrowing. Now, I'm just going to maybe explain that a lot of people say it's all to do with the increase of the money supply, but actually, if you look at it, the money supply isn't always increasing. It's actually related to the level of government debt and money. So if you think about it, when a government is running deficits and it's borrowing, the government gets poorer. It owes money. So as the government gets poorer, someone else is getting richer because the government's borrowed the money. So someone's got a bond now, they've got an asset, and the government spent the money. Now two people have the asset, and the government has a minus amount just once.
Yeah.
So they've just created wealth on the planet. So as they borrow, that makes people, someone, not everybody, but whoever happens to end up with those assets, richer. And as they get richer, they reallocate the assets in their portfolio to buy other things, and whether that's more properties or more Leonardo da Vinci paintings or more gold or whatever they happen to have their eye on that particular week. They're just going to reallocate their assets because they don't want to have all their money in US treasuries or or British gilts or whatever, or ECB bonds.
If we look at what happens next, I think that's kind of like the whole premise of this podcast anyway, is building new wealth for the new world. And I don't think just traditional diversification, which is great in your traditional portion of your portfolio, I don't think that's going to cut it for the new world if there is this fundamental change going on, this shift going on, or this decay of the actual plumbing that powers everything, right? So if there is this change going on, then how does it actually move on from here? Like, to me, what you're describing is a currency reset. It sounds like a debt jubilee of some sort, which isn't unusual in the distant past, but we haven't seen that, or my generation really hasn't seen that. So can you walk me through what would likely happen between today and the future? And we don't know what that time frame will be, but what happens next?
Well, first of all, I'd like to say there are multiple scenarios which could play out, from a hyperinflation scenario. Another scenario would be some sort of outright sudden currency reset, where you wake up tomorrow and there's some sort of crisis going on. Maybe there's been an earthquake in California, or there's a war, and national emergency dictates that we have to restart the currency, and you suddenly find that you've got new pounds or new dollars instead of old pounds or dollars. That's a currency reset. You might find we move on to some sort of ration type system. Now, when I was very, very young in the UK, we had ration coupons. It was a kind of leftover from the war. They were dying out. But during the war years, for example, if you wanted to buy a pound of butter, you could only buy the pound of butter if you had a ration coupon to go with it. So it didn't matter if you were a multi-millionaire or anything. You were restricted on what you could spend according to the ration coupons you had. So you had the ration coupon in one hand and the money, same amount of money in the other hand, and only if you had the two could you spend it. So the ration coupons were distributed equitably, so everybody had the same number of coupons, so the same number for rice, same number for sugar, same number for butter, same number for petrol. Nobody could have more than their fair share of anything, no matter how rich you were. Of course, behind the scenes, these ration coupons could change hands in the kind of black market. That obviously was going on. But, the government could move to that type of system. And then once you've got this ration coupon system moving, it's quite easy to say, well, don't need the money at all. Just pay with your ration coupon. And now the ration coupon is now the money. And the entire system is running on, they don't call the ration coupons because they won't call it that, but the entire system is running on new dollars, and you've left behind the old dollars in a defunct currency. And how would that work? How could that work as an example? Well, this, by the way, this is just one scenario. There are other scenarios, and I'll come on to why all the scenarios are bad if you hold government bonds or bad if you hold cash. But this is just one scenario. Let's suppose the central bank digital currency has arrived, and I'm not sure it's going to arrive, but let's say it has arrived, and people are now using that currency, that CBDC, which is a government-controlled, or rather it's a central bank-controlled currency, for all their transactions. Doesn't start off like that. You can still use other things, but over a while, gradually it becomes a situation where you can only use the CBDC either on your phone or the CBDC wallet that your bank is keeping on your behalf for transactions. Everything has to pass through the CBDC wallet for monitoring and control, anti-money laundering, those sort of things, and taxes, obviously.
Yeah.
Now the government's got a crisis. People are speculating against the government bond market, or they're speculating against the currency, or they're buying up the stuff in the shops, or there's a civil unrest or something like that. So what does the government say? They say, well, one of the problems we've got here with people speculating against us or buying everything in the shops is that we need to restrict what you can spend. So we're going to limit how much money you can put into your central bank digital wallet. We think $20,000 or £20,000 per person is the maximum you should have per month. So you can have your salary paid in, you can spend out of that wallet, but you can't have more than that unless you get permission. And you can get permission for certain things like a house purchase, or there'll be a variety of rules where you can get permission. And little by little, they squeeze the bottleneck so it becomes harder and harder for you to do anything except with your central bank digital currency. So the amount of money you can move from your old bank account into your central bank digital wallet will be squeezed so you can move less and less, whilst at the same time, the limits of what you can have in your central bank digital wallet will be going up. So if you're a wealth creator, you'll be able to have more in your digital wallet, but you won't be able to get that more from your old money. Your old money will be left behind as a defunct currency. I'll tell you in a minute why this is potentially fantastic for the world, but not good for those who are the bag holders.
I want to know who these bag holders are. Yeah, for sure.
The bag holders will be anybody who's got cash in the bank, cash in money market funds, who owns bonds of any description. That includes the government bonds, and it also includes corporate bonds, because all of these will be effectively in a currency which is either defunct or going to be defunct. It's going out. It's now trading it. If it's not worth nothing, it's trading at a very heavy discount to the original currency.
Can I ask one question on that? Just one question on that. So I understand like the cash and money market funds and the government bonds, corporate bonds, because effectively those are cash units and that is the defunct currency. But what about all traditional investments that might be denominated in that currency and held in traditional brokers and custodians? Would that not also fall in that category?
If you happen to own shares in a US company or a British company or a European company, you will still own your share of that business. Right. It'll be paying its dividends in the new currency, in the new CBDC or whatever the currency is, if ration coupons, if that's what we have. And I use that kind of facetiously because I don't think we ration coupons. You might remember a few years ago when Italy was running out of money, they were proposing to issue pre-tax payment certificates. So they're proposing to pay people who work for the government these tax certificates, which could be used to pay your taxes. And the idea was that so that would stop them, that would avoid the need for the government to borrow, which was against the law under the ECB law, and it would allow the population to start using these tax certificates as money. Mm-hmm. So they'd be effectively, they could pass them on to other people who had taxes to pay and get in exchange euros. The ECB stamped on that very heavily and said that's illegal. You'll be issuing a currency, and the only currency allowed in the European Union is the euro. Mm-hmm. And finally, they caved in and let Italy borrow some more money, which was what they needed to pay the bills. But you can imagine, so they won't call it ration coupons, but it could be some sort of coupon with, it could be luncheon vouchers, it could be tax benefits, it could be anything.
Toilet paper.
You're about to say.
Yeah. So I guess just going back to what you're saying before, though, so we have this throttled transition that we're allowed to move from our old money into the CBDC. Everything changes in terms of what we get paid now, presumably, depending on what we do, I guess, in the CBDC, and all the bag holders, all that old currency stuff is left behind. What would happen in a situation then? I'm not sure if this is inside what you would cover around this scenario, but let's say I own a property which is worth $1 million, pounds, and then I have a mortgage which is worth 500. What happens in that situation where that debt, effectively that's a bond, right? So does that wash away? And now I have something that in the future I could sell for the new currency, whatever that is?
When we've had currency resets in the past, which have taken many different types of forms, in general, those who had borrowed money to buy an asset did very well because to start with, they owned the house on one side and they owed the money on the other side. They had an asset and a liability which roughly matched. But after the currency failed, they owed money in a failed currency. So the failed currency went to zero, but they still owned the house. So there are many stories when you look around the world of people who were on the right side of it. They happen to have just bought a home before the currency failed, and there's many stories of people who unfortunately just sold their home or contracted to sell their home and then received payment in a currency which had already become defunct or was about to go defunct very quickly. So in general, it works for those who borrowed money. We can't say for sure how it would work this time around because it will depend on the laws of each country. Each country is going to have its own laws, its own way of doing things. I think in the German reset, which was when Eastern Germany reunited with Western Germany, I think that part of the mortgages were left behind in the old currency, effectively forgiven, but part had to be paid. I may have got that wrong. It may have been another one in Germany, but one of the German ones, it was a sort of fudged response to the mortgages.
Right. To get through this period of time, whenever it comes, if this scenario plays out, really, it doesn't necessarily mean that everyday investors today should be doing anything too different, apart from just be really cautious about those assets that feel safe today because they're cash and bonds, right? Like the 40% of the portfolio. Well, maybe
the man in the street, which is going to be a lot of your audience, has nothing to worry about because he won't have very much money. And what he has, they will allow conversion of that to the new currency. What they won't allow conversion of is the very large balances. So as you know, most of the wealth is owned by the top 5% or 10% of the population, and 90% of the population have much, much less, and probably 50% of the population have got nothing at all. So those who are lower down the ranks will find that they get their small balances converted over. And they'll be happy because their mortgage, if they have one, has probably gone to zero. Their credit card debt has probably gone to zero. And they've got much more spending money at their disposal because the government no longer needs to take money out of their pay packet to service a bloated national debt because the national debt's left behind in some defunct currency. So the man in the street will be spending more and be relatively happy. And he'll also be quite pleased with himself that he did all right. And all these rich people got screwed over, losing their money, which they jolly well deserved to because they shouldn't have been so rich at my expense, is probably what he's thinking. But of course, the wealthy will be thinking, it's a great pity that I lost that million that I had on deposit, but at least I had my houses, I had my stock exchange portfolio, I had my gold, and if you're super rich, I had my yachts, my private island, and my Leonardo da Vinci. So there will be, they'll be all right, but it will be a kind of debt. It could be a debt jubilee in that way. And realistically speaking, that would be absolutely great for the world because, as I said, the man in the street would have more money in his pocket to spend, so that would be good for business. Business would be doing great because all their bonds that they've issued, more or less every business has got borrowings, not all, but most of them have, all their borrowings will be effectively zeroed out. So they now have net positive worth without liabilities, which means that they'll be able to re-borrow to build more factories, make more products, employ more staff. So the companies we find and the government will be doing just wonderfully because its debt to GDP ratio will be zero in the new currency, and they'll be able to borrow money like there's no tomorrow to bail out all their pension funds because the pension funds will need to be bailed out because they're full of bonds. They can start a universal basic income for all their disgruntled citizens to make sure that they're watching Netflix instead of rioting. The only people who are going to be a little bit peeved will be the ones who are the bank holders, the ones who had very large balances, which is the majority of the wealth on the planet.
Mm,
So if you happen to be a foreigner, if so let's say you're in the UK and you own European government bonds, there's no way they're going to bail. There's no way the Europeans are going to bail out the Brit who's got a European government bond. If you're in New Zealand and you have a US dollar bond, you're not going to be the US government's not going to bail you out. They'll look after their own citizens by paying them the universal basic income UBI and maybe some form of compensation if up to a limit.
mm.
But foreign holders won't be compensated at all, nor will foreign governments. So if you're the government of China or Japan and holding a trillion of T-bills, well, bad luck. You're now holding $1 billion of junk.
So what you're describing here is, and I'm not a physicist and I'm terrible. I can't even remember my high school education, but it sounds like one of the laws of thermodynamics: energy can neither be created nor destroyed. It can just move around. Let's just say financial energy can't be created or destroyed. It can just be moved around. So what you're describing here is a redistribution of financial energy from that 5%, which is really concentrated throughout the entire system. You're painting a picture which I'm sure the 95 wouldn't be offended with. That's for sure. This sounds like a pretty good scenario here.
Yeah, in one sense, it's a wealth destruction event.
Right.
But if you're in that 5 or 10% who've got the money or the wealth, and it's in other things, you're not going to be too unhappy because the way we keep score is at the moment in the currency we have today. Yeah. New Zealand dollars, US dollars, British pounds, and suddenly everything you own in the currency in which you're keeping score is worth a lot more. In fact, it's worth infinity. Mm. So from a certain sense, from a mindset, you've made a ton of money. I mean, people are looking at the stock market and saying, hey, I made a lot of money, sometimes not realizing that the money they made is worth a lot less. Mm. Now, if you take that to extremes, you look at the best performing stock markets in the world, they're in Argentina and Venezuela. Why is it Argentina and Venezuela? Because the value of the currency is going down a lot. Does somebody in Argentina say, I've made a ton of money in the stock market? Well, he has, but actually the ton of money he's made isn't worth as much as it was a year ago.
That's the part, I think, which brings us back to kind of where we started as well, is that you didn't say this explicitly, by the way. I'm just putting these words into your mouth in terms of paraphrasing. What I heard at the start was that maybe the lion's share of a lot of what investors' returns are is actually, in fact, just currency debasement. We just don't like to acknowledge it like that. Like you can, gin, whiskey, wine, beer, doesn't matter what your poison is. It's the alcohol, right? And that's kind of what we're doing when we're investing. We're diversifying, but really we're just catching that wave of currency debasement, and we're doing it kind of like in slow motion now. But what we're describing is the end state, which makes it sound like it's instant. It might be instant, but this could just be a slow death where we just feel really wealthy until all of a sudden we wake up one day and wow, something just changed.
I think you've described it very well. And I once again, I want to stress that the scenario I just painted about replacement of the currency with the CBDC or another currency, it's one of many scenarios which are out there. There are other scenarios which have been played out in history. We don't know how it'll play out. But what we do know, and I can say for sure, is if you happen to be a holder of a fiat asset, by that I mean a bond of any description, or a deposit, or cash, it's not going to buy you as much a share of the world's wealth as if you held other things.
What other things are we talking about here?
So the kinds of things which will retain their value are the kinds of things which are wanted, desired, and in general useful. So that would include property. That would include equities, which are shares of business if they pay you dividends. It would include gold because it's been coveted by man ever since the beginning of time, and central banks will potentially need it if we go into a gold-backed system. That's another scenario we can see where they revalue gold upwards 10 or 20 times or whatever, and back the currency to restore confidence. That is a possibility. But central banks will still want to have their gold, so that's going to have a value. We can look at the collectibles, heirlooms, tangibles of all descriptions. There's nothing wrong if you want to become a collector of rare vintage whiskies, for example. I'm sure they're going to hold their value because there'll never be any more of them if the distillery has gone out of business.
Good point. EV manufacturers. I don't know. So I guess what you're saying is that there's no real fundamental change to how everyday investors ought to allocate and ought to think about the future. A little bit of changes around the edges, but really just having that mental framework to understand that should things evolve further in this direction, this is one of the ways that things could go. But at the same time, if we imagine what this new world looks like at that financial layer, but we ignore the other parts of your life that might change as well, we're not getting the whole picture. Because if that's bad, then we might not be able to keep on stacking our investments. So does this transition, if it goes like this, does this feel like a more authoritarian world where there's way less freedom of speech and individual expression, way less freedom of movement? Or what am I missing? Because it feels like it's too good to be true so far, in my mind anyway.
Yeah, well, in the West, we've become very accustomed to having a lot of freedom of speech and information and the right to protest and so on. But I can see that we could be moving back into the kind of controlled world that we had many, many decades ago, well, hundreds of years ago in some countries. Governments are taking more and more ways to have the information about their citizens and know what's going on. I'm going to give you a very, very simple example of how they can know things. There was a story in the newspaper a few weeks ago. A young lad was flying on holiday, either he was going to Spain or Portugal or somewhere like that, and he was joking with his friends about Al Qaeda. And when he got on before he got on the plane, he was in the airport and he just texted through WhatsApp to his friends, "Oh, when I get on the plane, I'm going to blow it up, ha ha." Of course, this was a joke, an ongoing joke. Somehow, that message got picked up by the Secret Service or whoever. He was already in the air by the time they decided what to do. They sent jet fighters to accompany the aeroplane. When it landed in Spain, he was duly arrested, and I forget what he had to pay. Something like £700,000 in fines, and potentially faced a prison sentence for a joke. But the real point here is they knew what he'd said, the keyword. It does mean that we're very much spied upon, and you don't know where. Even if that information they're not doing anything with it, it's being stored somewhere, and if they decide to go and take a look at you, it's there. And it's very hard, extremely hard. I mean, I've looked at the possibility of going what they call offline. You can't do that. It's impossible. If you want to live a normal life, you can't be offline. Therefore, you have to accept this invasion of privacy. And that does mean the opportunity for us to go into a dystopian world is much higher because the governments will have everything they need to get you if they decide to go after you.
Gold and Bitcoin are my two kind of things that I would allocate towards and that I would talk to my clients about, just because I know that they're outside of the financial system, at least alternative forms of money, especially in the physical sense with gold and in the self-custodied sense with Bitcoin. I want to know what your views are around gold first, because I've yet to meet someone who fully understands gold and is rooted in the real world, like you seem to be, and also understands Bitcoin. And so that's why this is quite cool that I'm able to talk to you about this. So your recommendation around gold, just generally, what would you say to a friend, to yourself?
So I'm 66 or something like that, 67 years old, I think. I've forgotten. Luckily, I've forgotten. But I got my first gold coin at around the age of 14. That was the sovereign that my grandfather had shown me. He gave it to me, and he told me never to sell it, and I've still got it to this day. I have a few more of them now. But we might well go into a situation where the world has to go back onto a gold standard, or some sort of backing by something. And the reason for that is if we have a failure of a major Western country, I think they'll all fail very quickly in succession, and people will worry the same thing will happen again. So to get trust into the currency, governments will need to back it with something, and gold would be the traditional asset. And that explains why some of the largest central banks are acquiring gold month after month, because those who have the most gold will call the shots, and those who have some gold will at least be sitting at the table. And those who have no gold, well, they'll do as they're told. The others will decide for them.
That's an awesome quote. Yeah.
We're going to have ongoing demand for the central banks. And if and when some kind of distrust starts to arise in the currency, and if people start to fear what I described as a scenario earlier, where we might get a restriction of what we can use our money for, or at least what we can convert into a usable money, I think there could be a sudden rush for gold or silver. So I think everybody should own some gold, and there's multiple ways you can own that. So first of all, having some self-custodied at home is always a good idea, because it means only you know that you've got it. It's easy to hide. Nobody knows where it is. Nobody knows how much you've got. They can't pass a law saying, well, they can pass a law saying you've got to hand it in. But just as happened in 1933 when they passed that law, not all of it got handed in. In fact, it's very, very easy today to buy, literally for the gold price, all kinds of American gold coins issued before 1933, which ought to have been turned in, and obviously they weren't. So not all got turned in. But if it's at home, you have a choice. If it's in the bank, you might not have a choice. So I think if you can buy a kilogram bag of silver coins from the old years and have that at home, that could be useful if we have a bank holiday of a few weeks and you need to go out and buy a loaf of bread. You can take your old shilling or sixpence or threepenny bit and probably get yourself some food. And I can guarantee you people will take it if there's no other choice.
Yeah.
In fact, they'll prefer to take it if they don't trust the currency. So that would be your first way. Of course, you could then go and have your bank buy gold and store gold bars in custody for you. You can also buy exchange traded funds, ETFs as they're known. Some people say that's not safe because the government could just help themselves to that in an emergency, as happened in the United States. The world didn't have ETFs back then, but basically in 1934, the government helped itself to all the Federal Reserve's gold because it was a national emergency, and they felt that the government should have it, not the Federal Reserve. So this could, and of course they'd already helped themselves to the population's gold a year earlier than that. So if it's in custody, your risks are a little bit higher. I don't think that's going to happen, but you have to accept it's a possibility. So that was a question on gold, and I think you should. Oh, you can own gold shares. The one thing to say about gold shares is they're incredibly cheap compared with the gold price.
You're talking about miners as well. You're talking about mining stocks, correct?
Yeah, mining stocks.
Yeah.
So for the most part, they're all fairly close to multi-year lows, 10-year lows, something like that. Whilst at the same time, the gold price is almost at a record price. It means that gold miners are a very neglected sector of the market. They're very, very cheap. And if people start to get interested in gold mining stocks are going to accelerate much faster than the gold price. Right now, we have no interest in gold at all. It's creeping up a little bit because of the central bank buying. But from the public at large, the interest is very low. But that interest can come back very quickly and without warning, especially if there's a sudden distrust in the currency. And of course, people will not only buy physical gold, they'll at that moment be buying the gold miners because they offer the better reward.
Sure. It's like a derivative. So thinking about the central banks and what you said before, where they are acquiring a lot more gold carefully, not to sort of make a big deal out of what they're doing, because that'll jack up the price. And then I guess we'll lose faith because we'll see what they're doing. But I want to ask you a question, which is a little bit on the edge, because I don't understand why. I don't understand. I wrestle with the question of whether or not this is known by central bankers. Is this kind of like the playbook that you think they already well know about, and therefore they're getting the gold in anticipation? Yeah. Okay.
Absolutely, they know. So most central banks are run by very intelligent and skilled people who've passed all kinds of economics degrees and law and so on. They know what money is. They know how things could play out,
Mm,
and they have to be prepared with a plan B because they know the system that we have at the moment has to be replaced sooner or later, and probably sooner. And they need to. Those who know and those who've got the power to do so are
mm,
basically saying we've got to jack up our gold reserves. Even
interesting.
countries like Turkey, which have got very high inflation, are jacking up their gold reserves
Yeah.
because they think sooner or later we're going to have to back it by something.
Yeah, interesting. So there's a lot of strategy going on here, but their assumption is that it's gold. And I don't know this for sure, but it doesn't seem like they would put much weight on Bitcoin. So let's talk about Bitcoin, if that's all right. Like what I look at as the analog hedge through gold, I just look at Bitcoin as the digital hedge in this context. Do you see that there is much different? Like, is it pretty much the same sort of use case? We have something that's a digital asset, which is scarce, it's outside of the financial system, decentralized, unconfiscatable. Is that the right way to be looking at Bitcoin just in terms of hedging first?
Whilst there's a lot of similarities between gold and Bitcoin, they are definitely different asset classes. And so I think that every asset allocation grid should have a column for precious metals and a column for Bitcoin. And then it's down to the asset allocator what number goes in the column for Bitcoin, whether it's zero or if he's in love with it, something much higher. And it's great that we now have, thanks to the ETFs getting approval on the 12th of January this year, it's great that we now have a tacit acceptance that it is a valid asset class which could be put in a portfolio. So I think the world has changed from the 10th of January, 11th of January, when the ETFs got their approvals, because suddenly we moved from a situation where it was probably risky to put the word Bitcoin in your asset allocation grid, and now it's almost obligatory, or it ought to be. I mean, I don't think it'll go in straight away for most asset allocators, but over time, over the next 2 or 3 years, I think they're going to add that column,
Mm,
and then it'll start at zero for some, and maybe start at 1 or 2% for others. But I think it makes sense to have it in. There's many people who would say that Bitcoin is the hardest asset on the planet, unlike gold, which can continue to be mined. This year, for the first time ever, after the halvening, which happens in about 55 days,
yeah.
the amount of the amount of Bitcoin being mined for the first time ever will drop below the amount of gold being mined as a percentage of the above ground supply. So gold will, from April this year, become the harder asset in terms of new supply. They call that the stock to flow ratio, i.e., the amount being produced relative to the amount which is out there.
Bitcoin will be, yeah.
Yes, Bitcoin will be harder than gold, and I think a lot of people can see that. And but more importantly, I think a lot of people would like to have it in their portfolio.
Yeah. Well, I know, and like I follow a couple of different schools of thought around this, including people that just think still it's rat poison, and people who are 100% all in the Bitcoin maxis. You've come up with a pretty rational framework for an allocation. I'll let you maybe share what that is, and obviously this isn't investment advice, but if it was you, what would you do if you had, say, a 30-year investment time frame ahead of you, and you were trying to allocate across all the asset classes that were appropriate for you, of course, but you wanted to include Bitcoin? How much Bitcoin would you include in your portfolio?
First of all, I think that depends whether it's your portfolio, your own portfolio, or somebody else's portfolio. So I think what I'll do, I'll speak to start with my lifetime career of an asset allocator's hat.
Sure.
About 6 or 9 months ago, on LinkedIn, I published what I thought was an ideal asset allocation for a multimillionaire. In the asset allocation, we don't look at the things which are illiquid, like his home, his properties, his works of art, his heirlooms, the things he can't touch or won't touch, private equity. You take that out of the equation, and the rest is what's investable, and that's what I would do the asset allocation with. So the rest is what you get to 100% with. And I thought at the time, and I put this on the grid, that the Bitcoin allocation should be 2%.
Mm.
Now that's a number which can go up and down depending on the ebbs and flows I didn't adjust the allocation, and I haven't adjusted it. And I'm talking about an allocation which I would recommend for somebody who's got several millions of wealth. But I suppose probably shortly before the ETFs were given approval, I would have reduced that slightly, which was the wrong move, by the way, by 0.5%. It would have been the wrong move. Probably by about a month ago, and you probably saw I became extremely bullish about a month ago on Bitcoin. I would have increased that exposure to maybe as much as 3%.
Right.
And the reason I increased it to, or was wanting to increase it to 3%, I could see that the flows of money into the Bitcoin ETFs were roughly 10 times as much as the Bitcoin being mined, the value. So the Bitcoin being mined was 1/10 of the money flowing to the ETFs. In other words, money going to the ETFs was swallowing all of the newly mined Bitcoin. There's 900 Bitcoins mined per day, and it was the money going to the ETFs was swallowing or buying 9,000 Bitcoins on average per day. So obviously, that's the only way you can get those extra Bitcoins is ever higher prices, because you've got to force somebody to sell them, and the only way you're going to force them to sell them is with a higher price. And as they start to sell, the ones who the loose, what they call the paper hands, the weak hands, sell first, and then you gradually get through to the diamond hands who are very reluctant to sell at any price. That will take time. So what you get in such a situation is, in the early stages, the price has to rise to take out the Bitcoin from the paper hands, the weak holders. Mm-hmm. But as you continue to buy at that rate, there's less and less weak holders, and there's more and more diamond hands, or in Bitcoin terms, they call it the hodlers, HODLERS, as you'll know. And they become more and more reluctant to sell. And that means the price, in a certain sense, has to accelerate away. So I think I probably would have, I can tell you factually, I would have sold for my clients about 0.5% at around 43,000 just before the ETFs. I might have got, if I was lucky, I might have got 45,000. It then went down to about 40,000. And I would have probably gone back in at a higher price than I sold, maybe 47,000, because something had changed. What we now had visibility on how successful these ETFs were being, and all you have to do is keep an eye on the flow of money into the ETFs to know if the enthusiasm is dying away. But I don't think it is. I think what's going on here is a small number of institutions have added it to their asset allocation, their authorized asset allocation, and they've said to their portfolio managers, if you want to invest in this, you may up to 1%, 2%, whatever their figure is, up to you. So not all of those portfolio managers will have done it. And I can assure you that even if they were doing it, you don't do it for all your clients one day. It's not possible. It takes a long, long time, because usually the way it works, you speak to your client, say, you pick up the phone to one client a day, and you say, by the way, I just want to tell you, we're recommending that we have a small allocation to Bitcoin. Do you have any objections? You have a dialogue. So it takes time. So I think that for what's going on at the moment is, little by little, firms are going through the due diligence process, going through the compliance process, talking with their legal departments to decide if they're going to authorize the approval of Bitcoin ETFs in the asset allocation. The asset allocators are deciding if they want to have an allocation of 0 or something higher than 0. And that takes time too. And then the portfolio managers who've got the discretion to go up to whatever the limit is are deciding themselves whether to do it. So over time, we'll have more and more firms which approve it. That will take several years. Over time, we'll have more and more, the limit that they let you put in, it might start out at 0.5% or 1% or 2%. I think that if we step forward over the next 5 years, that limit will go up gradually. Some portfolio managers will say, you know what, I believe in it. They're going to go for it, and they're going to move their allocation to the maximum. Others are going to say I'm a little bit more cautious, and they're going to stay lower. And some are going to say it's a load of bollocks. I can't believe I should have bought it at 20,000. Now it's 50,000. Oh God, it's 100,000. No, if I thought it was bad at 20, it must be bad at 100. If you take any asset on the planet, you'll find plenty of people who hate it and plenty of people who love it. So
Mm.
I'm not a great lover of Nvidia. But now I think about it, I had a conversation with my banker a year ago when he said, what do we do? How can we play artificial intelligence? I said, well, the way we do it, play it is Nvidia, and I didn't buy it. And I'm kicking myself. I can't possibly buy it at 10 times the price. I didn't buy it at. It just makes no sense.
Yeah,
So people are feeling that way. People feel that way about Bitcoin. If they didn't get in,
that's
they're
right.
embarrassed, and they don't want to say that it's a good asset when they said it was a bad asset before.
Well, especially people in the wealth management space as well, who have been historically, the ones that I follow anyway, have been quite anti-Bitcoin. So there has to be a certain amount of, I guess, the washing away of that hubris, and maybe people will just forget about all those social media posts. But not me. I'm keeping a scrapbook of them all.
Mhm.
So I
Well,
guess
I'm in Switzerland. In Switzerland, I think at least half the wealth managers, asset managers, have got some Bitcoin, but
right.
there'll always be somebody at a senior position, somebody who's got a very high salary, very important job, who's going to say, "I don't like it," because
Yeah.
he thinks that if he gives an approval for it, his job's at risk.
Interesting. And so you're way more aware of probably the larger portfolios in terms of your career. Like you kind of would appreciate some of these larger accounts, family offices, trusts, individuals, high net worth people. We're talking about serious amounts of money here. And if they start dipping their toes into an even like 0.5% allocation into Bitcoin, like give us an idea just as to the amount of money that could flow into Bitcoin, to be exact in terms of the dollar amount, but we're talking about serious numbers here, right?
uh, every billion which goes into Bitcoin has a multiplier effect. It doesn't mean the market cap of Bitcoin goes up. If you put $1 billion in Bitcoin, it doesn't mean the market cap of Bitcoin goes up a billion. It goes up many, many multiples of that. It depends on what you look at, but it could be up to 100 times as much for every billion. And the amount of billions which could go into Bitcoin and or trillions is there's an awful lot out there, but enough to drive. We've seen some very, very wild and crazy numbers as to the price Bitcoin could go to. None of them are actually crazy. They're all possible. It all depends on the multiplier effect and how much money goes in, how much money you have to put in. But it's very, very doable. I mean, I don't want to say if we put 1% of all the money on the planet, it could go to 5 million, but I think it probably would.
Mm.
But that's a bit like saying if every person on the planet owned 1 ounce of gold would be $1 million. All these are probably true facts. I know, probably not a million, maybe it's 50,000, but all these are true facts. But realistically speaking, it's not going to happen quite like that. But we'll certainly
Mm.
have a lot more money allocated to Bitcoin by investment managers in the future, and that will push the price higher, I think.
Yeah, no, I totally agree. Because on one side, there's the share of that it will probably get more of, and then on the other side, going back to the start, there's the currency debasement, which will likely accelerate. So there's all these factors going on. And then final question for you, Clive. Central banks, we know that they've been grabbing a good decent supply, good old dollop of gold recently in the last few years. Do you feel like they are set in their ways in terms of being anti-Bitcoin so much so that they wouldn't even dare consider putting Bitcoin on their balance sheets to prepare for the same event? Or do you think that they are kind of allocating towards Bitcoin quietly behind the scenes?
We did see a ridiculous comment from the ECB a couple of days ago. They said that Bitcoin has utterly failed in its promise to become a payment system or a money. Nobody uses it. It's never going to work as money. It never will be money.
Mm.
And I thought, who on earth wrote that? Have they never heard of Gresham's law? Who in their right mind is going to be spending Bitcoin, the hardest asset on the planet, when
Yeah.
they could be spending paper dollars or paper pounds, which are going down in value literally every day? Which one
Mm.
are you going to spend? It's like if I have a pocket full of gold sovereigns or
Mm.
Cooper nickel pounds, both a pound each. Am I going to spend the gold ones first, or am I going to spend the Cooper nickel ones first? Well, I'm going to spend the Cooper nickel ones first. So people aren't. It's not failed. It's just nobody in their right mind is going to want to be using their very valuable asset unless they want to use it to prove a point that it can be used. But they're not going to. But if the situation comes where we lose our trust in paper currencies and the merchants say, I want something sounder, totally easy to do almost infinite transactions on the Lightning Network. The Lightning Network is a high-speed Bitcoin network. It is Bitcoin. You can move Bitcoin around at the speed of light. You can do far more transactions than are going on in the credit card space. Literally zero cost of doing a transaction on the Lightning Network. So there's no real negative to stop people doing transactions in Bitcoin. It's just that nobody would want to necessarily do that, except if you want to move wealth around. If you want to move wealth from A to B or speculate or gamble on a Bitcoin exchange, that's fine. But you wouldn't buy a bar of chocolate or a cup of coffee with Bitcoin in the world we live in today. It makes no sense.
Because that's the good money. Keep the silver.
It's good money.
Use the plastic forks until then, right? And so they're either ignorant, but I kind of doubt it based on your previous comments, or there's some degree of malice. There's some degree of malintent.
It's quite clear there's quite a few central bankers who really don't like Bitcoin at all. Is that because Bitcoin is a currency, is a threat to the national system? Is it because it's showing them up as to how fast the value of the currency is going down? Is it because they've got to be in their bonnet about the fact that Bitcoin is used for money laundering? Now, that number that has to be addressed. I mean, I think Chain Analysis, who monitor these, have worked out that last year there was 0.5% of all Bitcoin was used for illegal activities, and 4% of all cash was used for illegal activities. And there's a lot more cash on the planet than there is Bitcoin. So these sort of comparisons saying hacks and things and money laundering and tax evasion are all Bitcoin, it doesn't seem to be quite as stacked up in terms of the hard evidence when you look at the numbers. I think the vast majority of people, when they earn Bitcoin, are owning it. If they put it in their own wallet, they're owning it because it's kind of a sovereign right to have some of your wealth in your hand where you have control of it. Nobody can look into your wallet and say, well, unless you told them that you have your wallet, and say it's yours. You can walk across the border of any country on the planet with your private keys in your head and arrive as wealthy as you left. You can't do that with a pocket full of gold. And if your shares or bonds are stuck in a bank, when you arrive, you might not be able to access them because of a war situation. But Bitcoin, wherever you happen to be, it'll be where you are.
Yeah. I love how just this conversation has gone, Clive, because there's nothing that is fringe or outside or unacceptable. It's just all part of investing, which is really just preparing for your future. So thank you very much, Clive. If people want to follow you and follow the post, like I know about you because of LinkedIn, and I've caught a few interviews of you on YouTube as well. But where's the best place for people to follow you?
I write only on LinkedIn. I would encourage people to get onto LinkedIn. Obviously, there's a free version, but you can follow me. And I write a lot of articles. A lot of people contact me as well. They have different types of wealth management questions. I'm a bit like a retired doctor. When you're working as a doctor, you get paid. When you're retired, people will still come up to you and ask you about their ailments, and you give the advice for free, which is what I do. I don't want to get any money for any of this. But I write a lot of interesting stories as well. For example, I wrote not so long ago a story about a man who committed suicide in a vat of beer in 1904.
That's good enough reason to follow you on LinkedIn, Clive, I'd suggest. So yeah, for any of those watching and listening, make sure that you follow Clive and myself, and you'll be better off for it. So yeah, once again, thank you very much, Clive. Really appreciate that. I'll let you enjoy the rest of your evening, I guess, there in Geneva, and hope to catch up with you again soon.
Thank you, Darcy, and thank you very much for having me on your show. And everybody who's listening and watching, thumbs up.
Awesome. Appreciate it. Thanks, Clive.